My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer. I do make friends. I'm just trying to make a little money. My job, not just to entertain, but to educate, to teach you about this business. So call me 1-800-743-CNBC. Tweet me at Jim Cramer. Maybe we have it all wrong. Maybe we've got the consumer all mixed up. We keep talking about how the consumer's overstretched, strapped, sapped. But what if the consumer's just fed up with paying higher prices for so many things for so long and has grown frugal and will eagerly jump at a bargain, but has no time for those who have not reined in their prices, even as COVID's been beaten? The new frugality is the mindset, and we, you and I, can profit from this incredibly powerful, but I think hitherto unrecognized trend until tonight. See, that's my conclusion after a day where the Dow inched up 16 points, S&P advanced 0.16%, NASDAQ gained 0.49%. NASDAQ's got some pretty good mega caps, of course. Now, I know this new frugality thesis isn't obvious, but you know why that is? It's because we keep getting thrown off the scent. Take yesterday. We learned that the CFO of Walmart, John David Rainey, total straight shooter, gave a talk where he said it'd be difficult for his company to beat its excellent first quarter. That was taken by Wall Street as what's known as a guide down. A bummer of a forecast. And Wall Street stock, Walmart stock, it got hammered. But if you do a simple ChatGPT query about what Rainey really said versus what he said on the last conference call, you'll find that he used almost the exact same quote. Basically, that whole talk was a non-event yesterday. So if you saw Walmart yesterday off the glib analysis that Walmart's having a suboptimal quarter, then you got it wrong. Walmart's everyday low price model and their rollback in prices for thousands of goods has made their merchandise incredibly appealing to the newly frugal consumer. Business remains incredibly strong, and the stores have never looked better. Lot that Wall Street ever goes to one of their stores. I'd like to invite them. They would really enjoy it. Now, that's the same reason why Costco is such a strong stock. It's amazing how they're pressuring suppliers to roll back prices. And every time I look, it feels like there's a new Kirkland signature brand, their house brand, that has more volume and a lower price and is in better, I got to tell you, is in better shape than any of the big brand names. I love their product. I always feel that Costco is in my corner. It's in my corner. Versus the greedy suppliers that want their prices back. They won't lower their prices. They won't lower prices to where they should have been. And they solved all the supply chain issues, right? They solved the transporters. They solved the raw cost inflation. But other than Costco, who's in my corner? I mentioned TJX last night as an all-price retailer, right? That's been getting the pick of the apparel litter because the full-priced outfits are basically just flat-out losers. They don't fit the profile of the newly frugal consumer and where she wants to shop. TJX, though, does. I highlighted this last time with that piece on Ollie's, the ultimate in closeout retailers. By the way, Matt Boss from JP Morgan, best retail analyst in America, he's noticed that Big Lots, another not-so-hot retailer, is on the ropes. If Big Lots were to liquidate, there'd be almost 1,400 locations for Ollie's to potentially pick and choose from to expand dramatically, increasing its footprint. Now, not to mention all the cheap closeout merchandise they can pick up for next to nothing. That would cause the stock of Ollie's to soar. And why not? It should. New frugality. The other two off-price plays, Ross stores and Burlington stores, are both performing at a high level. We know apparel inflation has been sticky in the consumer price index, but these four off-price chains are cutting the price of apparel aggressively. New frugality. Again, though, we keep getting thrown off of my thesis by smoke screens. You might think, wait a second, the consumer's clearly getting blasted because of all the dollar store stocks. They're getting crushed, right? Aren't they the last bastion of frugality? No, that would be wrong. They're not. I think people have realized that dollar stores have become relatively expensive places to buy goods. They raised their prices very aggressively during COVID. Even calling them dollar stores is a misnomer now. They definitely don't have the lowest prices. That's Walmart. That's Costco. The younger consumer, not the ones my age or even the 20 years younger ones, the ones who are in their 20s and 30s and live with this, they know how to measure what's going on. They measure price versus volume all the time. They can comparison shop much better than Sam Walton could because they've got constant internet access their whole lives. They won't let the dollar stores get away with their most latest round of inflation. They want prices lower. So the dollar store business declines don't spoil my new frugality thesis, because if you actually care about finding bargains, you don't want to shop there. On the other hand, look at the success of Temu and Shein, those two Chinese companies. You go on, well, Asian companies. You go online, you see their prices, and I have to tell you, they seem like mistakes. Because how could anything be so cheap? But no, the prices are actually real. The mistake is not taking advantage of them. Although sometimes taste may come into play, at least periodically. And as says someone who bought a lot of stuff from Temu for my wife, only to see it in the blue recyclable trash can the next day. Ouch. Now, when I said my feelings were hurt, she said, why? She threw it in the right bin. Let me give you another example, a little less anecdotal. Carnival reported tremendous numbers yesterday. You might think there's nothing frugal about taking a cruise, but what could be more discretionary than going on a cruise? That would be wrong. If you want to take a vacation, some of these cruise options are insanely cheap. Carnival's inside rooms range from $150 to $245 a night. Royal Caribbean, $175. Norwegian's $245. These prices are phenomenal. I mean, kind of ridiculously low when you compare it to hotel rooms and airfares. Right, by far the most value-conscious way to take a vacation. That's the new frugality. Yesterday, we talked about the horrendous sales of Pool Corp, which sells all sorts of swimming pool-related goods. I thought the problem initially was consumer pushback. It's true that with rates too high, it may be more expensive to take out a home equity loan to build a pool. But I want to dig you on this one. You know what I came up with? An alternative theory. The cost of labor, which has not yet come in. It's a big issue. Paying someone to fix up your home is borderline extortion right now because the contractors hold all the cards. It's simply become too expensive for most homeowners to afford. You need to see these costs come down before you see more pools being built. The cost of labor is too high for many homeowners. We've seen new boat sales plunging, too. Now, some of that's because they're pricey. But again, the frugal consumer is cagey and clever, and using the web constantly get a better deal. Guess what they found? They actually love boating more than ever, but they know it's too expensive to buy a boat. So what do? Brunswick bought Freedom Boat Club, a rental service. You don't have to keep up with maintenance or docking fees or financing costs. You just borrow the boat and return it when you're done. The value-conscious way to go boating. I am sure people, yes, indeed, who they rent it and they say, oh, I ought to have one. But I'm telling you, the renting society is beating the owning society. You wonder why the sales at CVS and Walgreens report tomorrow have been so weak? It's simple. I don't know who sold thinks that those stores are bargains. In the past, the drugstores were time savers. You could always drop in, get what you want, get out in 2 minutes. But the frugal consumer just doesn't spend money at these places now that everything's locked up behind plastic. Amazon tends to sell almost everything you can get from a CVS or Walgreens, and they usually deliver it the next day or even the same day in many parts of this country, and at a lower price. Order in the morning, you get back home, it's right there on your porch. It's waiting for you. Again, this younger class of consumers knows pricing better than any other retailer, and that usually puts Amazon ahead of the game. Let's not forget restaurants. Today, we got the flyers from McDonald's. I don't know if you're a loyal member, you might have seen it. They got a $5 meal going. They finally had to bring it back after raising prices endlessly. But I don't know if Mickey D's can get traction, and not just because of the small fries. Texas Roadhouse and Brinker are offering $11 dinners, much more food. They got great liquor options. They're so cheap that their sales are booming. Brinker, which is owner of Chili's, has leveraged the newly frugal consumer to the hilt and played it up on social media, and that's why that stock's been the best in the group. So let's suspend the notion that the consumer's totally strapped for cash. That's wrong. The bottom line is the consumer's finally pushing back and demanding better prices. We're no longer willing to be cowed into paying more than what something seems to be worth, which bodes very poorly for those stores that have yet to roll back their prices, but very well for the ones I've mentioned. Bottom line, the consumer's no mood to pay more for less. You just can't let the distraction of the false characterization throw you off the scent. If you offer the consumer a real bargain, not a dollar store one, that consumer is going to take it. Ryan in Michigan. Ryan.
Hi, Jim. Third time caller. Thank you for all your input.
Third time. I love that. We had a third timer last night. He turned out that he had the steak and he loved it and gave us a nice note. What's going on?
Thinking about I bought AT&T about a year ago at the low, and it's rallied nicely this year and has recently hit a 52-week high. Thinking to keep that, add some more. Verizon, T-Mobile, I like the yield on Verizon.
Okay, look, AT&T's come back at 52-week high, but, that's kind of from a low level. T-Mobile's got growth. I like growth. I am a big believer in growth. I want to go with T-Mobile. Now, look, we need to stop with the notion that the consumer is strapped for cash. Instead, accept that the consumer is fed up with paying unfair prices that were jacked up during COVID and needs to come down now. If they're offered a bargain, they will gladly take it. Maybe the guys who are extortionate should realize that Costco and Walmart are winners. I mean, money tonight. Levi's is falling after earnings. I'll go straight to the source. Let's find out what's really going on here before we just dump the stock, please. And speaking of apparel, a winner's emerged in a space that we haven't focused on. And I'll reveal what it is and why I think it can keep running and why it's got the wrong name. and it isn't RH. And Paychex has a solid read on the state of medium and small businesses, and with investors concerned about economic growth, I'm getting a sense of where we stand with the CEO, really. So stay with the newly frugal Cramer.
Don't miss a second of Mad Money. Follow at Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Tonight we got results from Levi Strauss & Co., the iconic denim company with a stock that's nearly doubled from its lows last October. It's been about a hand-wringing about the consumer. This time Levi's reported what technically looked like a mixed quarter, and an ever so slight revenue miss paired with a substantial 5-cent earnings beat off an 11-cent basis. While management left their full-year forecast intact, not ideal after an earnings beat, they also spelled out that they expect a 5-cent earnings hit from their new logistics strategy and an increased marketing budget in the second half, along with currency fluctuation. In other words, despite these new costs and investments, Levi's can still hit the number they previously guided for. That's exceedingly positive. You don't get a stock up 40% for the year for doing nothing. Sometimes this market has trouble appreciating nuance. So let's take a close look with Michelle Goss. She's the president and CEO of Levi Strauss & Company. To get a better read of the situation. Ms. Goss, welcome back to Mad Money.
Hey, Jim. Great to see you again. Great to be here.
You've just been crushing it, taking advantage of what is a remarkable wave in denim and then really augmenting it. Tell us how you were able to, with inline revenues, crush the earnings estimates.
Yeah, well, to that point, Jim, I mean, we were thrilled to deliver another strong quarter, up 8%, reported up 9% constant currency. And to your point, with a very big earnings beat. And we're expecting this momentum to accelerate in the back half of the year. And first and foremost, it starts with growth. And our DTC business is just on fire. I mean, we delivered another double-digit quarter. We were up 11%, driven off of 9 consecutive quarters of strong comp growth. And then the second shout out I would give you, Jim, is on our women's business. I mean, our women's business, we've been at this for a while, but we are amplifying it and sharpening that strategy, and it's working. So our business was up over 20% in our DTC channel. And then to your point on profitability, that's a very big focus. We delivered record gross margins this quarter and are driving a lot of efficiencies through our key enabler, Project Fuel.
Okay, talking about the strength of the consumer, a lot of people are hand-wringing about the health of them. I feel if they get a deal, if they get a bargain, if they like something, they're spending it. It really is not a consumer who's strapped. It's a consumer who's just more particular.
Yes, I completely agree with you on that. I mean, we see our consumers as being really resilient, and we're excited about the category. I mean, as the category leader, it's our responsibility to drive a lot of innovation and excitement. And I think we're doing that in a couple ways. One is driving the next evolution of the trend, which is going baggier and looser and wider across both men and women. And then also this whole head-to-toe denim lifestyle. I mean, that's really our new focus is, yes, continuing to own jeans, but taking that denim top to bottom. Things like denim skirts and denim dresses, which historically have not been big businesses for us. I mean, they're exploding up triple digits in the quarter.
But let's talk about, you talk about fashion, talk about excitement. Obviously, anybody who likes Beyonce, like my wife who plays this endlessly, talks about the new album. It's a country album, but it's got a Levi Strauss, Levi's jeans song. And what's that meant for your business?
Yeah, well, I would first say, I mean, we could not be more humbled, more honored, and of course excited that the fact that Beyonce, who is such a global cultural icon, would name a song after us. You know, and this is we've had a relationship with her over a decade. So like I said, we're just so honored about this. You know, as it relates to the business, our business is really being driven off of the key strategies that we spoke to, the strength in our direct-to-consumer channel, globally, strengthen the U.S. in particular, our biggest market, 3 quarters now of growth, what's happening with women's and what's happening with denim bottoms with this next fashion cycle.
All right, well, when I look at things that I know some people are trying to sell the stock down, look, the stock's been such a home run. I could understand if anyone wants to take profits. But the only thing, the nitpicking I would have was that I was surprised that Europe was weaker. Maybe you can explain that to me.
Yeah, I'd say Europe actually met our expectations, Jim. And we saw sequential improvement since the first quarter. And we're still believing that we're going to see Europe return to growth in the back half. DTC was positive. Our wholesale is improving. And we expect both channels to improve in the back half across the strategies we've been talking about. Women's, denim dressing, denim lifestyle, our tops business, that's been an area of focus for some time. We doubled down this last year, did a whole reset on our tops business, growing over 20%. And that impacts Europe as well.
Okay, excellent. You did mention something just now with wholesale. I was quite impressed. You had the inflection. I was been waiting for it, and you had it. What does it mean for your bottom line?
I think it's an important question, because when we talk about DTC first, which is operating the company this way, and DTC being our key growth driver, wholesale is still really important, right? I mean, we're going to continue to reach millions of fans around the world through wholesale. We saw improvement from Q1 to Q2. We expect that to continue, really driven off of, number one, product, right? Driving relevant product. We have so much excitement. I was talking about bag or looser. We're also bringing a lot of fabric innovation. I mean, it's summertime, and we've got a great new performance cool platform that we're launching around the world. So it starts with product across both channels. Women's, again, is outperforming. I should actually mention that women's claimed the number one market share here in the U.S., and it's doing really well around the world as well. So wholesale, I'm excited. The other thing it's worth mentioning is last year this time, we were struggling with a lot of headwinds in our supply chain. That's all behind us. So we have seen a step change in execution from a year ago.
Now, I know Mr. Singh, Harmit Singh, is just a great CFO, one of the best. I've known him for a very long time. Yes. So why don't you just tell us how he's doing with Project Fuel, explanation for what's going on there.
Yeah, so great question. So Project Fuel it's going to be a multi-year initiative. It really is a key enabler for us making this pivot to be a DTC first, retailer, omni-channel retailer. And we have our sights set on growing this business. We're, again, pleased what we've seen the last couple of quarters, but growing this business to be $10 billion and expanding our margins to 15%. And Project Fuel is a really critical part of that. We have multiple work streams across the company. I'd point to a couple. One is, we talk about being a retailer. It's getting that productivity and profitability up in our stores. You saw our numbers this quarter. We're making good progress. You're seeing the results. That's going to continue forward. Rewiring the company to be faster, more agile. So our whole go-to-market process is getting a lot tighter and shorter. That's another one. Indirect procurement. I mean, the list goes on. And again, great confidence that we're going to ultimately drive a lot of growth up to that 10 billion, 15%, but especially on the margin side. You saw it this quarter, and you can expect to see a lot more in the coming months.
Yeah, when you have gross margins of 60.5%, up 180 basis points, I'm trying to think about what other apparel companies are delivering those numbers. They're very hard to come by. I don't know. Maybe you just quickly explain that this is not an easy number to reach.
You are absolutely right. And it is a good bellwether to the health of the business. And we have many work streams that are feeding that. I mean, first of all, it certainly starts with our cost of goods. And as you said, that number, it's a record number for the company. We are so proud, and the teams have been working really hard. So relative to our supply chain, cost of goods coming in, exceeding expectations, our DTC penetration driving a lot of great favorability there to our conversation we were just having, higher full price selling in our direct-to-consumer channel. So all of these things are helping us support, that gross margin, which, as you know, turns into gross margin dollars, which helps us get that leverage on the bottom line.
Well, just terrific work. Thank you for coming on. Once again, the stock has been a rocket. Some people may not understand. It's a little harder to understand this quarter than it was the previous one. But the fact is the bottom line was fabulous. Top line's good. And you're doing a fantastic job. Michelle Goss, President and CEO of Levi's. Thank you.
Thank you so much, Jim. Great to be here.
Absolutely. Mad Money's back after the break. We keep hearing that consumers are strapped for cash, that they're just not spending like they used to, and it's wreaking havoc in retail. But all retailers are not created equal. Some are more equal than others. When you look closely, there's still plenty of winners in this group. Consider the case of Urban Outfitters, which you also know as Anthropologie, Free People, FP Movement, and Nuuly, that's N-U-U-L-Y if you don't know that. The latter being an apparel subscription service aimed at women. Honestly, I haven't given this story enough credit in the last few years because it's spent decades lost in the wilderness, but now the stock has more than doubled from its lows set just over 2 years ago, so clearly something's going right. Yep, at the moment, Urban's doing incredibly well. It's just hard to notice because the company has so many moving parts, and the namesake brand is the worst of them. Other than Urban Outfitters, the store, though, Urban Outfitters, the business, has a lot going for it. On the retail side, which is over 90% of the business, Urban's got a network of 719 stores and a quality digital business. When you look at their sales by brand, the namesake Urban Outfitters brand is no longer number one. Did you know that? Now Anthropologie is number one, accounting for 43% of last year's sales. Urban Outfitters barely edged out Free People segment for second place last year. Can you imagine? Making up 26% of the company's sales versus 25% for Free People. This year, Free People will be larger because it's growing rapidly while Urban Outfitters' nameplate keeps shrinking, stagnating, shrinking. I don't know. Not good. All this is profitable. It's all profitable with the exception of Nuuly, the apparel subscription service that they launched 5 years ago, and that's still very much in pure growth mode. I don't even mind that it doesn't make any money yet, because it's less than 5% of sales at the moment, but it is growing like a weed, and I love the business model. Put it all together, you can understand why the company did so well last year. Urban's adjusted net sales were up 7.7%, and when you drill down, some of these brands are on fire. Anthropologie had 12% same-store sales growth. That's incredible. Free People same-store sales were up more than 21%. That's been consistently high. It's only Urban Outfitters that keeps dragging things down. Comps falling nearly 14%. That's not good. They took a small hit on their tiny wholesale business, but that new subscription service, get this, 89% adjusted net sales growth with average active subscribers up 82%. In the end, the company earned $3.25 per share. That's up from $1.75 the year before. That is spectacular earnings growth. Just as important, Urban came into the new fiscal year with tight inventories, meaning they didn't have to do much excess merchandise, didn't need to aggressively mark down in order to get it of the stores. There was not a lot of promotions, except, again, at the core Urban Outfitters brand. Now, last year's overall numbers were excellent. They reported an ugly fiscal fourth quarter in February with disappointing revenue, same-store sales, and earnings. Even though Urban had a great holiday season, the fourth quarter includes January, and the business decelerated rapidly that month. January is not that important, but people don't think like that. At the time, management made some mixed comments about how February was going. They said same-store sales were a bit softer than the fourth quarter, but ahead of their plan for the current quarter. Given that Urban doesn't give explicit guidance, investors were left to interpret that amorphous statement on their own, and many read it negatively. That typically happens, by the way. If companies have to understand, if you leave it somewhat tepid, they're going to say it's extremely tepid. Doesn't help that the company made some positive pre-announcements at the conference the previous month, making people feel like management might be clueless. Boy, are they ever not clueless. The stock had run up to $47 right before the report in late February, came down to $41 the next day, and then, as Wall Street got even more worried about the consumer, the stock fell even further, and then Jefferies hit it with this brutal downgrade in mid-April, citing proprietary data showing a notable deceleration in foot traffic. Keep that proprietary data from me, please. The stock got hit again, falling to $36 and change, but that was rough patch in March and April. It was a head fake. Because on May 21, Urban Outfitters reported a terrific quarter. Better than expected sales, rising margin, declining inventory, 15-cent earnings beat on 54-cent basis. Everything you want to see. Management said they had high single-digit growth in their digital growth paired with low single-digit growth in brick-and-mortar sales. That's fine. Breaking that down, listen to this. Free People delivered 17.1 same-store sales growth. Street was only looking for 14 before. Anthropologie up 10.4. Street was only looking for 8. The only finding that went again was Urban Outfitters. The company was the Urban Outfitters brand, which saw a worse-than-expected same-store sales decline of 13.7%. See the pattern coming here? Now, wholesale is finally growing again, thanks to the strength of the Free People brand. That means they're selling it to other stores. And that was something, by the way, that Macy's called out specifically. Newly, Urban's subscription business had 51% sales growth, all good. On the conference call, founder, chairman, and CEO Dick Hayne sounded almost gleeful, touting the strength of Anthropologie and Free People. But he also noted that Urban Outfitters brand is now under new leadership, and customers seem to be responding well to the changes that the new team is making. Hayne even hinted at some encouraging signs for the Urban Outfitters banner in May. I don't know. I also like what Hayne had to say about the consumer. He sounded a little more nuanced than the typical retail executive, which is why we felt which it felt different. Listen to this. I'm going to quote. As a group, we believe they are currently in good shape, enjoying both solid job security and incomes that are rising slightly faster than inflation. They are still excited by our new fashion offerings and traffic in stores, and online remains strongly positive. But their purchases are slightly more considerate than last year, end quote. Hain then sums it up. Quote, overall, I would classify the consumer mood this versus last year as enthusiastic rather than exuberant. We believe this new mood, it's healthier because it's more sustainable, end quote. I like that. Now, it sounds good to me, right? But Urban's stock actually dropped 4% the next day, although it rebounded almost immediately and hasn't looked back since. I bet it can keep running as Urban sells for less than 12 times this year's earnings estimate. And if they can keep beating the numbers like last quarter, the stock will look even cheaper in retrospect. Buy. In the end, Urban Outfitters may not seem like all that enticing at first. But that's because it's a complicated story, and people don't have any ability to discern a complicated story. Levi Strauss is a complicated story tonight. But when you do the homework, you realize that Urban's got something very special going on here. The company's largest brand, Anthropologie, excellent shape, double-digit same-store sales, 5 straight quarters. Best part of the business is the white-hot Free People brand, which has been white-hot for a long time. It will soon supplant the Urban Outfitters brand as second largest segment. And while it's still too small to move the needle, I'm telling you, you got to be optimistic about this newly subscription service. It's clearly gaining traction and growing like crazy. It fits the taste of the new frugality that I talked about at the top of the show. By the way, when I was glamping with my daughter in Montana last week, she dressed almost entirely with Nuuly. I was so excited because one of them had the price tag in it. That means she was early on in the rental of that outfit. Okay, maybe that's somewhat anecdotal, but I like to point it out anyway. Really, the only bad part of the Urban Outfitters story is Urban Outfitters. The brand might be time for the change of a name. What do you think? I've got some ideas. Ben Stoddard and I fooling around a little bit. The softness at Urban, the store, seems to carry outsized weight. Maybe they should call the company Free People. They can't call it RH. That's taken. Call it Free People. Maybe they should call it Anthropologie. Or how about this? FP&A. Free People and Anthropologie. All right, maybe, how about this? Philadelphia Fashion Co., because they're based in Philadelphia. How about that? I'd like that. Either way, management clearly isn't happy with the performance of Urban Outfitters, the brand. I'm betting that the new leadership and the new strategy can eventually turn things around. But the bottom line right now, Urban Outfitters, but the bottom line right now, Anthropologie, but the bottom line right now, Free People, has quietly become one of the better stories in all of retail. And at less than 12 times earnings, I think the stock deserves a lot more love than it's getting. And makes sense to buy right now, right here, before they change the name to something smarter like the ones that we've suggested. Let's go to Tony in Florida. Tony.
Hey, Jim, I'd just like to thank you for taking my call, and you have a great team, and looking forward to tomorrow's
the conference call, fantastic, and our team is amazing. The team actually helps me in the conference call, too. It's really it's a virtuous circle. How can I help?
Yeah, I don't know if I should do this with the stocks I have some ammunition, because I know you and Jeff always say, we're fighting it, and I'm fighting this one really bad, and it's down, but it gives me a 3.5 dividend, and I do still drink beer, even though I take the shot. Is TAP something I should hold on to or sell it so I have ammunition for tomorrow?
Okay, TAP is a very complicated story. I have to tell you, I've done a lot of work behind the scenes with this one and am shocked at this decline. Hattersley is doing a good job. The yield is great. You're right. I am shocked, honestly. This is like as people just say, listen, all their drinks are going to be hurt by the GLP-1s, but not Constellations, which you and I both know we're going to cover tomorrow on the conference call. I don't think you should sell Molson. If anything, I want to buy it, but it is so hard to buck the GLP-1 thesis that anything alcohol is no longer going to be drank. They just think that people lose the taste for it. Beer is experiential. It is not just about alcohol consumption. Urban Outfitters has become one of the better stories in the retail space. I think the stock deserves a lot more love than it's been getting. Maybe it's the name. Much more made money, including my Susan with Paychex. Stock falling 6% if the earnings are investors getting this great buying opportunity like they usually have after a quarter, or is there a real warning this time? I'm getting the latest from the CEO. Then after the report turned in by FedEx last night, investors are focused on buybacks. I'm sharing the companies that are being the most aggressive in what it means. And of course, order calls rapid fire tonight's edition of the Lightning Round. So stay with Cramer. All right, what happened? happened with the stock of Paychex today, the payroll processing / outsourced human capital management company. Look, I love these guys because they can tell us a great deal about the state of small and medium-sized business in America. In fact, did you know that the company helps process the paychecks for 1 out of every 12 Americans in the private sector? So when the company reported a solid set of results this morning, an outlook that was a little less strong than I wanted, even though the full-year forecast was fine, well, you better believe I paid attention. Wall Street certainly didn't like it. The stock taking a beating, down 6%. But look, anyone who follows Paychex knows that its stock tends to sell off after earnings no matter what. So could this be another buying opportunity? It's been almost every single time. Or do we need to be maybe more concerned? And I'm being too glib. I don't know. Let's check in with John Gibson. He's the president and CEO of Paychex. Get a better sense of the quarter and what comes next. Mr. Gibson, welcome back to Mad Money.
Hey, Jim, it's great to be back with you.
Oh, thank you, John. You know, when we go over these quarters, there was a sense that maybe you were going to you gave us a preview, maybe do 5. It comes in 4 to 5.5. I mean, to me, these are rounding errors. At the same time, some people feel that business has, to some degree, gotten tougher for you. So let's try to figure out whether that's the case. We didn't have a huge number of new client gains, but in the perspective of revenues and earnings, things were terrific.
Yeah, Jim, I think you said it from the start. It seems like whenever we beat and reaffirm guidance for the next fiscal year, we seem to drift down. I'm not sure why that happens. What I'll tell you is we had very solid results. We exceeded consensus both on revenue and earnings per share in the fourth quarter. In fact, when you look at the fourth quarter, as you know, we've had this program, the ERTC program, where we've been helping clients. It's a one-time service charge. When you exclude that, our revenue grew 8%. In the fourth quarter, and adjusted earnings per share 15%. And in fact, our growth actually accelerated in the second half of the year. You mentioned the client growth. Our client growth this past fiscal year was slightly better than the prior fiscal year. And we had a good year this year. So when you look at our business, I would tell you very solid results. When you look at our HR outsourcing business, particularly our PO business, growing at double digits, our retirement business, double digits, we're well positioned going into this next fiscal year.
All right, good, because that was my thinking. I know that there are people who would say, well, wait a second. They said there's a tight labor market. They said it's because it's still hard to find people. But at the same time, you did say that small businesses continue to hire. The Small Business Employment Watch that you shall tell us about, one month gain in job growth, best since January 2022. I mean, so there's a lot of good things happening in small business, and you're doing your usual to help the small business and then making some good numbers from it. I don't know. It seems like business as usual to me.
Yeah, look, Jim, we look at our index, and what we continue to see is moderate growth for small businesses. But we're seeing growth. We're also seeing labor inflation continue to cool, which I hope the Fed sees as a good sign to take further action. But again, we saw all regions improve in our May report. What I would say, Jim, it's stable. You pointed out the real issue. When we went out, because one of the things we didn't understand this past fiscal year was with an economy growing at the rate it was, our models would suggest that we were going to be seeing more hiring inside our client base. And we just simply weren't seeing that. Now, I'll tell you, in the fourth quarter, we actually saw growth in both our payroll and our HR outsourcing businesses. So after a couple quarters of increase, so that's a good sign. When we went out and talked to clients, what we found was they were having problems finding qualified people. So we actually created a product called the Employer of Choice Playbook. We introduced it first in our PEO. And we're actually going out and leveraging technology, data analytics, and our dedicated HR professionals to actually build customized plans for our clients to help them go into the market and attract, using technology and AI, more qualified employees for their business.
Well, why don't we talk about a qualified employee? Because I think a person who is not qualified. I don't want to get Republican or Democrat here, but I've run a lot of businesses. But the minimum wage is high. And versus where it's been. But people say, listen, the workers don't make nearly as much as the bosses. So I get all those arguments. But I did feel this time, when I read through your call, that it's possible that the minimum wage is hurting. For the first time, I really feel like this, hurting hiring. Because there's a lot of people who like to hire under the minimum wage, but they don't want to because they feel like they can't fire anybody. And they're not able to grow if it's going to be this continually higher rate versus what would have been now that we have a lot more people coming into the workforce. But do you feel like I do after listening to your call that the minimum wage is hurting hiring in some places?
Well, look, Jim, I think that employers learned a lot of lessons during the pandemic and the various employment shocks that we had during that time. And so I think when we had the situation where a lot of people were hiring anyone they could find, what they found was when they hired someone that wasn't as qualified or not as high a quality as they generally wanted, that person actually had a negative impact on the culture and the productivity of their current employees. And so one of the interesting things, Jim, is, we really monitor. We have our HR professionals engaging. We actually have over 158 years of recorded calls just last year alone that we transcribed and done analytics on. And what you find is when people were hiring a lot of people, we had a lot of employee relations related matters. Now, to your point, it may be that the price is a little bit higher. Now they're being a little more picky because they're paying a higher wage. What I will tell you is people want to have qualified workers, and they're not going to settle for anything less because I think they learned a lot of lessons during the pandemic.
All right, that's a much more thoughtful response than I'm thinking. Sometimes you get the knee-jerk way of like, wow, because it's about how people do at the workplace far more than $1 or $2 for minimum wage. Let me ask you one thing that I am really concerned about, which is there is a retirement saving crisis in this country. People don't put money away. They don't know how. I've seen it so many times personally. You guys are doing something about it. What can we all do about it?
Yeah, Jim, you and I talked about it the last time we spoke. Very concerned about this. As you think about the aging population and the impact that this is going to have socially on us if we don't deal with it now, we know a lot about the 401k business. We're the largest record keeper. We have over 120,000 clients. We open a lot of the new plans that are out there. Jim, when you think about it, it's kind of concerning. In the 1980s, almost 50% of the working population was on a pension plan. There was a means for those people to retire. You look at it today, we believe there's upwards to 60 million people that have no retirement savings plan at all. And so certainly we've been supporting the Secure Act and the Secure Act 2, which were passed. Those are great steps forward. We're also supporting the RISE Act. One of the things, there was a loophole put in Secure Act 2.0 that needs to get closed, and we got bipartisan support. And it really hinders a small business, when I say micro business, under 5 employees, because they don't get the same level of tax credits as a larger firm. And this RISE Act would actually fill that. Now, you want you to think about that. Of the 6 million small businesses, over half of those are less than 5 employees. So that leaves a lot of workers on the sidelines. And, in the states, we've had about 20 states that have implemented a retirement plan. There's 12 others considering it. In those states that had enacted that, we saw marked improvements in the savings rates in those states. Right. And so I really hope this is something that policymakers can get behind.
All right, I'm going to push for this, too. It just makes no sense. I don't like it. I don't want people to feel like they have to work until they die because they've saved no money. That's not the American way. Well, I want to thank you so much, John Gibson, President and CEO of Paychex. Paychex, this is another regular, consistent, good quarter. Good to see you.
Great seeing you, Jim. Thank you.
Mad Money's back after the break. It is time. It's time for the light round. Chris, that's what about for a woman. Saving the stock. I said about my so just better to know the course of stock questions. My steppers. We play this out. And then the lightning round is over. Are you ready, Ski Daddy? Time for the light round. Chris, let's start with Mary Claire in Idaho. Mary Claire.
Jim Cramer. How are you? What a great day. I have been in your master class for 10 years.
Oh,
so here's
thank you,
my question.
Thank you.
Yeah, I love it. Here's my question. Cassava Sciences, it's an all-timer play. And the ticker is SAV.
No, I know it because of neurodegenerative diseases, and I do a lot of work with the neuro case, and I will say this. If they can have something big, that stock triples. If they don't, I think it drifts down. I like that risk reward, but I understand it's speculative. Let's go to Dave in Illinois. Dave.
Dr. Cramer, my mad recent Montana and Wyoming National Parks visitor. How are you?
Indeed, I am doing, well, obviously, Dave, as you know, I am doing unbelievably well because of that trip. And how about you, my friend?
Well as well. Jim, this $6 billion company develops and manufactures diagnostic and therapeutic products for the treatment of heart, cancer, and other diseases. Lantheus Holdings has outperformed the S&P and is up over 25% on the year. Jim, your thoughts on LNTH?
I think it's great. Now, you know we own Danaher, Dave, and we talk about that tomorrow at noon for our for the CNBC Investing Club conference. But Lantheus is terrific. I wish, honestly, that Danaher would just buy them. I think that would be great news. And as always, I thank you for your call. And that, ladies and gentlemen, conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, one stock is recently delivered for shareholders. Is more joy on the way? Cramer checks out FedEx. Next.
FedEx delivered a spectacular quarter last night, dramatically reduced expenses, possible sale of its freight division, which would likely be worth more as a standalone entity, and some amazing earnings growth on a fairly small bump in revenues. And that's how a stock finishes up $40 in a session. But for many analysts, what really stuck out was the increase in the already humongous buyback. For the 2024 fiscal year, FedEx spent $2.5 billion on share repurchase. They retired roughly 3.9% of the whole share count. Now the company's announced it's going back to the well, expect to repurchase another $2.5 billion in the new fiscal year, including $1 billion in this first quarter alone. That's aggressive. It shows confidence. CNBC.com ran this fantastic piece yesterday about buybacks, but just like this one. And it put things in perspective. The number one buyback in the last year was Marathon Petroleum. Shrunk its share count by 19%. And, of course, its stock then went up 54% over the same period. General Motors is number two, where CEO Mary Barra has overseen a 17% decline in the share count. Stock's up almost 25%. Consider the performance of the endlessly talked about Tesla, though, as a counterweight. Stock that's declined more than 18%. Forever competitor Ford down 14%. Tesla doesn't have a buyback. I mean, they can't afford to do it. They're losing too much money. Ford, among the cheapest stocks, the S&P needs to step up and do a buyback. That 5% yield ain't doing nothing. Now, it's possible that no amount of stock buybacks can actually make a difference if you're in the wrong sector. State Street, the bank known for its custody work, has bought back 11% of the shares, but that stock's up less than 3% over the past year. Builders First Source has also retired 11% of the shares, yet its stock's up less than 7%. The supply, the home builders, look, the home builders are holding up too well. They don't do a lot of building these days. If they don't do a lot of building, they don't need more building for stuff from First Source. Of course, if you're in the right industry, everything's great. Valero and other refiners bought back 10% of the shares, and the stock's up 36%. Rounding out the double-digit repurchases, there's J-Bill, contract manufacturer, also retired 10%, but its stock has only seen a gain of 10%. Obviously, buybacks aren't panaceas, or else all these stocks will be up phenomenally. But they can be springboards for outsized moves if the underlying business is sound. The refiners knew they were in a golden age, so they stepped up in a big way. When people realized that they were having tremendous quarters, there simply weren't enough shares to go around, and that's why their stock soared. There wasn't enough supply. GM stock always seems to be devoid of sellers. Who wants to sell if GM might be the buyer if they're buying your stock hand over fist, which brings me full circle to FedEx. When you see the stock up more than 15% in a day, you can bet there simply isn't enough stock for sale, not enough supply at these higher levels. Not only were there very few sellers, but the buyback increases their performance dramatically, as their earnings per share will grow nicely if you've got far fewer shares as a divisor. That said, I don't like to chase stocks after such big moves. I can't count on it's paying out for FedEx right here, but you need to keep this buyback in your mind for the inevitable down day. Management's very bullish on its own stock, much more bullish, by the way, than the analysts, even after I read the morning notes. I think after this quarter, FedEx has forever changed its stripes. Combination of FedEx's additional buyback with even a fraction of a percent of the growth behind what it already has will lead to explosive earnings. After this quarter, it's become one of the best stocks to own in the entire market. I bet it becomes a coiled spring the next time it goes down. Congratulations are due to CEO Raj Subramanian. The transformation's working, the job's getting done, and the shareholders are the real winners, which is exactly as it should be. I like to say there's always more market summer. I promise I'll find it just for you right here in Miami. I'm Jim Cramer. I'll see you tomorrow. Last call starts now.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.